so I know a bit more about your business. Let's say you're looking to raise some money, you can benefit from a UK investor getting some tax relief from their investment in your business. So, but there is a process that you as a company needs to undertake. So this is called the process, the slides are the process of seeking advance assurance. So before I, as an investor, want to come and put money into your business, I want to make sure that, let's say I put in 100K into your business, I want to make sure that I'll be able to claim back 50 up to £50,000 from the government in my tax return. So there's quite a lot of paperwork that needs to be carried out for this process with HMRC. But once you've done that paperwork, within sometimes as early as a week, but normally up to 4 weeks later, you would actually get the advance assurance certificate from HMRC to confirm that your business, you should be able to claim the benefit from the scheme. So a lot of this stuff you may not have prepared, but I want to make sure you're aware that just in the mindset, it's not as simple as going to HMRC and saying, I want to be advanced assurance qualifying. You need to have a business plan, and it doesn't have to be too complicated. It can just be a few pages long, but you need to have a structured business plan to flag what you're looking to do, what the business is, and how, more importantly, how much you're looking to raise and what you're going to do with that business, with that funds. Because what HMRC don't want to happen is that they give tax relief to investors, but that money just sits in the company not doing anything. So they actually make it quite a point to make sure in the business plan or any sort of cover letter to HMRC for the advance assurance that you write down exactly what you're going to do with the funds, whether it's developex costs, user experience costs, marketing costs. Some of you probably wouldn't have latest accounts, so I would ignore that. And again, most of you will qualify for this type of relief, but there's certain company businesses such as nursing homes, pharmacies, professional services firms, banking, those don't qualify for so some fintech businesses may not qualify for advanced assurance. So it's worth speaking to someone or looking at the fine print or the government guidance to make sure that your business qualifies before you go down the advanced assurance route. But there are ways around it depending on how complicated the business is, or if there's a different way of structuring the trading activities to ensure that you can claim advanced assurance. So it's worth spending some time understanding whether your business qualifies. Again, all of you who'd have a UK company would have an up-to-date article, so I won't spend too much time on that. What's actually quite annoying that they've done is that you actually need to supposedly know who your shareholders are. And I didn't mention this last time, but it's very rare. Oh, I think someone's about to join, and I'll just yeah. Hello, Eva. I know you just joined. We're just talking about the SEIS, EIS Advance Assurance. So if someone's looking to raise money, what are the process involved in order to go to HMRC to request for advance assurance? So one of the things which is quite annoying is that they're asking you to name the potential investors that are looking to jump into your business. But as I said last time, it's very rare that you know who your investors are. But the workaround is very much if you have any expression of interest. So let's say, for example, you went to a venture capitalist forum and you had some interest, having potentially those names on there might be quite useful, and that should be enough. But it's a very quirky, it's as if like HMRC don't understand the real world, where how can you know who your investors are when you haven't even had a chance to explain the business plan to them or even seek advance assurance. And the last point is they want you to complete quite an onerous checklist, and it's downloadable on their company's. I'll just close some of these. Yeah, I won't probably go into that detail now. Oh, if you have just joined, don't worry. Oh, sorry. Yeah, so there is a checklist for each of these. And also, if you've got a social enterprise, there's a similar relief for this as well. So depending on how your company is set up, there is great investment tax relief for a social enterprise where they can claim back, an investor can claim back relief. So you can see there's quite a lot of tasks required, and sometimes doing it on your own can be a bit daunting, and accountants do provide this service. But not only that, what you don't want to do is have this constant toing and froing with HMRC, because if you don't nail all these questions straight away, you could find that you're spending a lot of time responding to HMRC rather than getting that advance assurance and allowing you to go out to market to raise that finance so very quickly. So I had a client recently where we submitted the advance assurance, and surprisingly within a week they got the advance assurance back, and that's super fast compared to historic days. But I expect I would say 4 to 8 weeks depending on their capacity, the HMRC. But only once you have that, I mean, you may remember, or you may see on Seedrs or CrowdCube, when you go and do a crowdfunding application, you may see a little icon or thumbnail saying SEIS, EIS approved. So this is what happens at the back end, just to give you some context. Now, there's a lot of text on this slide again, but I'll point you through the main points. The key point here is that what some of you, let's say, again, I'm going to use Arthur as an example. He's just raised money. I've invested, say, 100,000 in his business, and now he's got the money in his bank account. I'm going to go, how do I, as an investor, go and claim back my SEIS, EIS tax relief? So let's say I invested 100K in SEIS tax relief. I want to claim back £50,000. But before I can do that, Arthur's company, they need to complete an EIS 1 compliance statement, and they can only do this if it's an EIS investment after 4 months of active trading or qualifying R&D. So let's say he's developing his platform or developing other aspects of his business. And again, there are a few other points for SEIS 1 compliance statement. You do need to have spent 70% of my £100,000 before I can go and claim back the tax. So the only reason why I'm saying this is so that when you speak to investors, you need to know how the UK government sponsor basically investors and how investors can get their money back, because what you don't want to find is that they know more about this whole process than you, and then you are not able to negotiate as well when it comes to equity ownership and managing the dynamics there. So, and I'll come on to diluted versus undiluted shares later, but I just want to make sure you as entrepreneurs understand that there is a process for seeking advance assurance. Once you've got the advance assurance, you do need to understand there is a bit of paperwork required to complete within a certain amount of time to allow the investors to actually receive a certificate. So then they actually receive I think it's called an EIS 3 form or SEIS 3 form, and then they will complete that and submit that in their tax return, and then they'll be able to receive that 50,000, or I will be able to receive that £50,000 back. So it's very important to understand that. I appreciate some of you might find this may not be that relevant right now, but I definitely feel that if you are looking to grow and scale up rapidly and you want to get angel investing and angel investment, you need to understand the timing aspects of allowing the investor to get back their tax relief via, I should say, EIS rather than the ESI. Okay, so I'll just go on to the next slide. So before I jump, is there any questions on the process? Because in one of the sessions I had last time, we spent, there's quite a few questions on this. So that's why I've spent some time creating some structure to helping you understand the process for seeking advance assurance. No, and feel free to unmute or answer the question. Otherwise, I will just crack on.
Hello.
Hello. Asif.
Hi,
Oh, Ali, sorry, Ali.
Someone wrote a couple of questions first, so I'll let them go ahead first.
Oh, very kind of you. So I will take that on board. So I just found them. Actually, no, in case it's sensitive. In case there is, oh no, it's everyone. In case there is more than one investor, how does the firm show that 70% of a particular investor has been spent? That's a very good question. So what you got to remember is that when you issue shares for an investment round, so let's say I'm going to invest in Asif's business, but there's also a friend of mine also going to invest, and you don't want to really do 2 different dates. You just want to do the share investment on the same day. So let's say today's date is the 8th. So tomorrow is the 9th. So I invest 100K tomorrow, but so does my friend John. He invests 30K as well. So back to your question, that's £130,000 of investment on the 9th of March. So 130 times 70% is 39 minus 130. So it's around 91, I believe. So you need to make sure you spent that one, thank you, 91 K before you can actually go and complete that form. I mean, I'd actually recommend getting this form ready by just sending it once you've spent that money, just so that you're kind of ready and there's no new, because it's quite a, some of those questions are a bit technical, so you don't want to wait till later while it's all fresh in your mind when you're preparing the advance assurance, you can get it ready. So hopefully that answers your question, Asif. To answer your question, it's all together on an aggregate basis on the day of investment. So let's say 2 weeks later, actually, you have another investment round, then it'll be 70% of that investment. Only then you can make another claim, you can make another form, SEIS 1 or EIS 1 form request to HMRC. Ali, question to you, back to you.
Yes, thank you. I just wanted to ask about two additional options that I learned about to raise investments: the convertible loan note and the advanced. Sorry, I sent this privately by accident.
Oh, I haven't seen that. Okay, yep.
I'll send it again. Convertible loan note, advanced subscription agreements, as well as I'm wondering if one of our co-founders is not in Lebanon. Sorry, is not in London. I'm in Lebanon.
Yes.
In the UK, does that affect? Does that have implications on taxation?
Okay, so Ali, I'm just going to understand that question. Your co-founders, or you're based in Lebanon, right?
Right. I'm moving to the UK next week actually, but my co-founder is still in Lebanon.
Sure. So, but you're not looking to raise money. It's your investors, right?
Right.
Sorry, let me start again. You are not going to be the SEIS EIS. If the investor is a UK resident and has UK tax to pay, then it's only useful, because if you think about it, if you're non-UK resident, you may not have income tax to pay, so you can't actually claim back the tax relief because there's no tax to pay. So the reason why this is mainly useful for UK investors is because they have actually got income tax they're paying, and investing in an SEIS EIS company allows them to get a refund. Right. So, but your question is very much, you as co-founders are currently not based in the UK. Is that right?
That's right. At least one of us isn't. I mean, I have the entrepreneurship visa, sorry, the startup visa, but I'm going to operate with that.
So to answer your question, I don't think there's an issue, because it's a UK company, and one of you will be in the UK, so it doesn't matter. I mean, I do recall a lot of the time before, there was a lot of solar panel investments in India, which were actually claiming EIS. So they were claiming EIS companies, even though the actual operations were in India. But what I'm trying to say is that it shouldn't be an issue that the founders are not based in, one of them is not based in the UK and the other one is. It's more about the investors. They're in the UK and they've got income tax to pay, and they can then offset it against investments into this company. Does that answer your question on that first half?
Yeah. Yes, thank you. Also, just ask about other types of agreements: convertible loan notes, advanced subscription agreements.
Yes.
Will we be covering this in this?
No, I haven't put it on here, but I can touch base on it. So because I think I wasn't sure, how far people have got down on their route. So I wanted to make sure they understand the process first. But I think the advanced subscription agreement, what that is very much when you don't have a price set for the valuation. So let's say, for example, you're looking to raise money, but you don't really want to set a valuation for it right now. So what you do is you actually allow people to commit to funds, commit to an investment into your business, but then only once you've got a VC fund or someone significant to come into your company. Let's say that comes in at, say, a valuation of $1 million, then that advanced subscription, the investors who came in at the advanced subscription level, they'll come in at a slight discount. So that's how that works. I mean, do you want to know more about how that process works, or are you just sort of getting a feel for what it is?
I'm personally exploring all my options, so that's
Yes.
why I asked about these additional documents. But I guess if other participants are interested, I'm also interested.
Yeah. Okay. That's good to know. I mean, what I'll do is, I'm just touching on your second point, convertible loan notes. So historically, or not historically, investing in a loan note doesn't allow you to benefit from the investor to benefit from EIS, SEIS, whereas advanced subscription agreement is very similar, a set concept where it allows you to get the money in and allows the investor to claim EIS, SEIS, but then only once a trigger point has happened, then the equity shares are issued. So it's a sort of different mechanism to allow the investors and the company to get what they want without it causing issues from stopping them from getting income tax relief. So I think for now, I'll stop there on that. Oh, another question. It would be great to know more about, it is a version of YC Safe or 500 Kiss. Oh, I don't know what that is. What's Arthur, I don't know what YC Safe is, or for some.
Hi, yeah, it's like the most used instrument to raise funds in the US. It's basically a convertible note, but without the interest rate. And
Yeah,
it doesn't say the valuations.
it doesn't say any stipulations. Yeah,
It doesn't set a valuation. So
yeah,
let's say it sets a cap.
yeah.
Yes. So you come as an investor, we sign a SAFE. It stands for simple agreements for future equity.
Yes.
And we set a cap, let's say, for 5 million in 1 year. And in 1 year, when another investor comes, we set that valuation in the future.
Yes, it sounds very similar to that. So just so everyone's clear, what Asif is Ali's asking is, oh great, so there is a bit of traction on this. Thank you for the engagement, everyone. So advanced assurance subscription, advanced subscription agreements, what it is on day one, you may not have a value, or you may not have all the funds committed. So you may not receive all the funds straight away. So an advanced subscription agreement is like a strong commitment from an investor. Say, I'm interested in your business, but you don't have a value yet set for the business. So what happens is that once at a certain point, there's a valuation triggered. So let's say when you've got a VC coming in, or you reached a certain hurdle of investment across a family of investors, then you hit a point, and then that individual will get a slight discount on that valuation. And it's very similar to what Arthur's suggesting, whereby it's not you don't get your money back. So it's not like a loan where it's very much an equity position where you're going to get shares, and because it also qualifies for EIS, SEIS, it's a very attractive proposition where you're effectively allowing people to get the income tax relief before having to set a valuation, and you're building your book of investors rather than having to constantly, again, coming back to a previous question, having to constantly do, say, if I invest now, say 110K, 2 months later, I'll get another investor for another 100K. It sort of stops that issue where you have constant different dates of investment. Whereas what this does, it creates one date, and then you have your pool of investors coming in on that share date, on that particular date, but they can still benefit from SEIS, EIS. So it's a win-win situation for the SEIS, EIS investors and the company. Okay, right. So I think that hopefully covers that. Now let me move on to the next point. So this is linked to an extent, but I think in the previous sessions, some of the people, and even during my one-to-one sessions, people just weren't familiar with how diluted versus undiluted share cap tables work. So I've just done a very quick table and example, just so people can understand, everyone on the call can understand how the dilution works. So let's take Ali, I'm just going to use you as an example. So, because you mentioned you've got 2 founders. So let's say founder A is you've got 6 million shares, and your other co-founder's got 4 million. And this could just be on day one, right? So right now, before you raise money, you've got 60-40% split, right? So you could go to investors right now and say, come into my business, I'll give you 10% equity. And if you do that, that means you'll reduce your share by 4, but then also, sorry, Ali, you will reduce your share by 6, and then your co-founder will reduce your share by 4. But actually, because you're potentially going to be a great scale up, you need to plan for the future. So what you want to tell your investors is that, yes, I have got currently the issued share capital is 60/40, but we are looking to also consider an employee share pool, but an option share pool. So on top of that, there's going to be other shares going to be issued, say in a year's time, of 500 here, and then a further 1.5 million shares. So you can see now, on a fully diluted basis, before any other external shareholder comes in, your shareholding has gone down to 50. Founder B's got 3, and there's a split here. And the reason why we say this is because if an investor thinks they're coming in at this percent, they're coming in 10% against these two, it can actually it'll be actually lower, because of once in a year's time, these share option pool shares are exercised, then this will dilute that original 10% that the investor is going to get. So I just want to make sure everyone is aware that when you talk to investors, you may want to, and when you also speak to your lawyers, you have to say to them on your share purchase agreement, make sure you have an allocation, if you want to, or for a pool, which will be, say, up to 5 or 10% for your EMI share options or any other pool that you have, and then make sure that all parties who are involved really understand which one you're talking about, because what you don't want is the investors thinking that they're talking about this issued share capital, which is only 60/40, but when you're actually giving them shares, you're talking about the investment on a fully diluted basis. So what's normally recommended is that they understand the position right now. So let's say they invest 10% now, it'll be split accordingly here, but then actually it'll be less than 10%, because they'll have 10% on day one now, but then it'll be reduced by X amount because of these dilutions. So it's just making sure that the investor's aware that you've got this in place. Otherwise, they may find that in a year's time, they originally thought they had 10% of the business subject to any further equity raise, but actually that 10% is to be diluted by 15%. Oh no, 17%. Okay. Any questions on that, or shall I move on? And feel free to unmute if it's easier rather than typing, because again, want to try and make this as interactive as possible.
Sorry, just the 10% you mentioned goes from the option pool or from the founders' shares?
Oh, so the key point I probably should have mentioned is pro rata is a very important term that I'm sure many of you heard of, but it's worth knowing. So let's say you are investor A. So I think that was Ali who mentioned that question, right? So let's say 60/40 is currently the issued share capital. If I come in as an investor of 100K into your business today, then that will be reduced by 6, and that will be reduced by 4, and then I will receive 10. So it'll be on a pro rata basis. That's how that concept works. And on a fully diluted basis, it'll be the same thing, where each of these will be reduced by 5. So each of these will be reduced on a pro rata basis by 10%. Because if I did that, if I did 0.3, 0.4, 0.33, 0.5, that will get to another line here for Yogesh at 10%. So this will always stay at 100%, but these get diluted. Does that help you answer your question? I think that was a yes. Okay, great. Right, so I'm actually going to jump now to VAT, because I think I had quite a few questions on that, and something which a lot of people are not aware of, but it's important to be aware of so it doesn't become an issue later. And HMRC, you don't want HMRC knocking on your door later on if you had issues from a HMRC sales value-added tax perspective. So first of all, to bring it into context, I just want to flag that when you first set up a company, or even set up a sole trade business, you do not need to be VAT registered. and you don't need to straight away jump into it, but you do need to be compulsory VAT registered once your turnover goes over £85,000. And that and the key point here is that, let's say you're selling things outside the UK, or your particular goods or services are exempt from VAT. So that 85k excludes the VAT exempt figure. And that's quite important. So let's say my business, where we provide accounting and tax services. So if we provide services to somebody outside the UK, because it's a service-based business, we don't have to charge VAT on that invoice to, say, I think, Ali, I think you mentioned you were in Lebanon. So let's say I gave you advice for something in relation to UK advice, but you're based overseas. That would be an exempt supply for me. So that wouldn't create, when I do my calculation to work out my 85k, that would not be included in the 85k calculation. It's slightly different for goods, but I'm just sort of giving you that context where some people think that if they look at their turnover and straight away it's above 85k, they'll have to straight away register. Don't forget about the VAT exempt amount, just in case it saves you from having to VAT register, because I'm sure you all know, if you do VAT register, all your consumer clients or any businesses who are not VAT registered will now have to pay up to 20% VAT. Obviously, there's different rates for different sectors, but up to is a sort of 20% is a general figure that you're probably familiar with. And another thing I wanted to flag is this compulsory registration of 85k. There's two sort of routes that you have to consider when you're looking at whether or not you need to VAT register. And so what they try to catch here in this first one is, let's say, I don't know, again, I'm going to point on someone who's based in the UK. Oh, actually, I don't know on the group here if anyone is based in the UK, but I'll just say, let's say LJ, actually, I know she's based local. So I'm about to engage her on something, and her job is going to cost me £90,000, and historically my turnover has always been less than 85. So because that particular job on its own, or in the next 30 days, is going to create my balance to go over 85k, they're trying to catch it so that any future figure within that 30-day period, if it's above 85k, you'll be then compulsory required to VAT register. This is a more of a mathematically easier thing to understand. The second point, it's very much, if you look back over 12 months at any point in time, if your turnover is less than 85k, then you don't need to VAT register. So, and the other one was, you can also register voluntarily. You'd probably only do that if you've got huge amount of development costs or expenditure that you've been incurred VAT that you want to recover. But the only downside is that you'll need to start issuing VAT invoices to your customers, and you will have to file quarterly tax returns, so quarterly VAT returns. I did touch on this in a previous session, but I just think it's important to be aware of as you scale up, and VAT will become a consideration, because you will need to be more cloud focused in your approach to your accounting once you become VAT registered. It may not be as essential. And again, I did a whole session on the cloud accounting on session number 2. So you get a feel for the difference between basic Excel accounting using a bank statement. You may not need to use a cloud accounting system until you're VAT registered. So I'm just trying to bring it together using this slide when it comes to the 3 sessions. Any questions on that before I move on?
Hi, Yogesh. I having a small question.
Yes, sure. Is a couple?
Yeah.
Yes,
yeah,
carry
Patel.
on.
So
Yep.
we've been doing a fintech. We are promoting fintech company, which is primarily work on our developing countries to provide, technology platform. But we are thinking to set up an operation in UK. So our primarily the service we are be providing, it is outside of UK. So is it like probably not any revenue will come out of the UK? Is it for that kind of company? Is it necessary to have a VAT registration from the UK?
Yeah, so it's a very good question. And again, VAT is quite a technical area. And so it's worth knowing the rules. So with fintech businesses, basically, if the financial services, generally, my understanding is that they are exempt supplies. So what you're doing is you're providing a VAT exempt supply, even if it was in the UK. So the problem there is that yes, you won't need to VAT register because you may not go over the 85,000. But the issue is, let's say, Kapil, your development costs from the tech developer down the road in London is charging you £100,000 plus VAT for the development of the website. The problem there is that because you're not VAT registered, but more importantly, you're not providing VATable supplies, you can't simply VAT register if you wanted to and claim back that VAT. So it's a double-edged sword, really. In one way, you may not need to VAT register because you're not providing VATable supplies. But the downside is that in the future, as your costs for, say, I don't know, rent or expenses in the UK increase, which you may not do because I think you said you may not be basing yourself in the UK. So you won't be able to claim back that VAT. Does that make sense?
Yeah, it makes sense. So in order to get input tax credit kind of things, you need to have a VAT. But if you are not necessary to require input tax credit, you may think that you're not required VAT at that stage.
Yeah, I think, yeah, exactly. So it's very much, if you can't qualify for sales tax, then you can't claim back the input.
Makes sense, yeah.
Yeah, okay, good. Thank you for the question. Thank you. Okay, so I'll just go on to the next slide. No, before I do, who in the group thinks they may become VAT registered over the next few months or weeks? Any sort of icon or emoji or expression will be handy here, and then I'll talk you through an idea which can probably save you money. Okay. I'll still say something, even though I didn't get any noise from anyone. So what it is there's a concept called, actually, let me step back. So let's say, for example, your turnover is now above 85,000. So you then need to submit a registration form to HMRC to become VAT registered. And then they'll send you a VAT number. Now, the thing is, the government do help small businesses when it comes to VAT registration, because straight away, if you're a consumer-facing client, so if you're B2C, you'll be hit. Like your customers will be hit by having to pay 20%, up to 20% extra on their payments to you. So they know that's a big hit to small businesses. So there's various schemes that HMRC help introduce and provide to clients, businesses. And one of them, which I find quite useful for small businesses, is a flat rate scheme. So as long as your turnover is less than £150,000, up to that point, what they say is that you will on day one have to charge, say, 20% on your business, right, to your clients. But rather than faffing with the purchase invoices and rather than working out what is your claimable amount in the purchase, what they're saying is, we'll keep it very simple for you. What we'll do is, let's say your business is generating, say, £30,000 worth of revenue each month, and you're charging VAT on that. So 30 times 20 is 6K. Right, so normally you'd have to give back £6,000 to the government, HMRC, but what they're saying is that depending on what rate your business will be, there's a special rate that HMRC will apply to your business, and let's say that rate is, say, 10%. You only have to give back 10% of that 30K to HMRC, and the rest you can pocket, which is quite a nice thing. So the client thinks they're paying tax at 20%, and that doesn't go to you. But actually, if the rate HMRC has given to your business is 10%, you take the 6K, which is the 20% times 30, minus the 10% times 30, which is 3. So 6 minus 3 is 3K. That 3K goes straight into your profit. And I found clients actually benefit massively on this over years because they've kept their turnover below 150, or they're not a big business, but they're benefiting from these low rates. So if I And I'm just trying to show you, just as an example, the rates, so you get a feel for, oh no, I can't do it very easily. Yeah, here we go. So for example, let's say my business is accounting and bookkeeping. So you can see here this number 14.5. What that means is that on every sales invoice, I don't need to worry about, I think people asked me about the purchase invoices. It doesn't matter how much I spend. What they're saying is that if your sales, whatever your sales figure is, you times that by 14.5, and that's what you have to give back to HMRC. Anything between 20, which is the current rate, minus 14.5 will be sitting in my bank account, even though the customer has paid it to me, and that doesn't need to go to HMRC. So again, it's something to be aware of, that there are these useful schemes. There are others, but I just want to flag one because, again, VAT does hit small businesses, and this does help the situation. But I appreciate, hopefully, some of your businesses will be marketplaces, will be scale-ups, but when you first start out, bootstrapping and any sort of cash saving is very important. Okay, I think I've just walked through this example, even though I had this slide, but I'll just repeat it. A customer pays you £1,000, right? And then you have to pay 1.2k. As the invoice will be 1.2k because you've got £200 of VAT. If you're a photographer, on my list that I showed to you, the rate is 11%. So what we're saying is that you do 11% times 1.2, right? And that 11% times 1.2 is 132. The balance of 68, which is 200 minus 132, is income for the business. So I think that just walks through the example, another example I mentioned to you. There are obviously a few nuggets of considerations and criteria you to meet, but that's in a nutshell how one of these schemes work to support businesses who are VAT registered, get some extra cash flow help. So is there any questions on that when it comes to general VAT or flat rate scheme or registration? Okay, no worries. Oh,
Yogesh, hi, Asif here.
hi,
so just to clarify, you said that so there's nothing wrong with charging my clients 20% upfront, and then suppose I come onto a flat rate scheme, I'm 11%, 14%, whatever the rate is applicable for me. I can pocket the rest of it, and there's nothing wrong with it.
Yeah. So can I ask? I said, what is your business going to be? What sector?
No, so it's essentially a lot of it is mostly professional services consulting.
Yeah. So okay, fine. So yeah, to answer your question, you can see legal services, accounting services, and estate agents. They're all around 12 or 14.5%. So yes, you're right. The client, they won't even care or know that you're on the flat rate scheme. All they'll see is once you're VAT registered, you will have your VAT number on the invoice, and you will then issue the invoice plus VAT. And if they're a business, obviously they can generally reclaim that VAT on their side. But if they're a consumer, they will pay that 20%. But you will take that 20% on top of your net figure, and you'll only pay back, say, 11 or 14.5, depending on your rate. So to answer your question, it's pure cash flow benefit to you. No, sorry, yeah, pure cash to you. It's not a cash flow timing. It's pure profit, to be honest with you, to you. Does that answer your question?
All right, thank you. Yeah, thank you.
I mean, that's why I wanted to flag it. It's quite surprising to even hear that HMRC are willing to even have this scheme. But what they're trying to say is that it's less admin because you don't need to worry about all the purchases. So normally, for whoever doesn't know, when you do a VAT return, you've got to look at all your sales and times that by the VAT rate, so 20%, and then you look at all your purchases and whatever VAT you've incurred on those purchases, you net the two VATs off each other, and whatever the balance is, that's what you pay to HMRC. Whereas in a flat rate scheme, you don't even look at the purchases. All they're asking you to do is a very simple calculation, is take all your 1.2Ks here, so take all the invoices that you've got as sales, and then whatever the figure is there. So let's say you did 3 invoices of £1,000 plus VAT, that's 3,600. So all you do is do 3,600 times 11%, and that's what you pay to HMRC. You don't look at the purchases. So it's a very simple way of doing it. And again, it helps SMEs not having to panic and worry about spending time doing the VAT return. Okay, so.
But then that stays as long as you are below the 185K, 150K. All right, sorry.
Yeah, 150.
But then, in case if your turnover starts going up, what happens then? In that case, then I'm sure there must be a way from where, like, you move on from the flat rate scheme to the regular.
Yeah, I think it's 250K. Off the top of my head, I forgot the figures. I don't have many clients on this scheme, but I think it's 250K. Once you hit, so you can go into it from when you're up to 250K. And let me just, yeah, but I think so. 150K. Let's say you 85K is when you have to VAT register, and then you can. Let's say next month and then next month after that, you're below 150K over a 12-month period, then you can still claim the, you can still get onto the VAT scheme, VAT flat rate scheme. But I believe, and I'm just checking the rules while we're on the phone, on the session. Yeah, but it's 250. See if I just show you here. Maybe not. Here we go. If you intend, yeah, I can double check, but I think it's 250. I don't want to waste everyone's time. I believe it's there is a cap, so you can't just always be on in a flat rate scheme. I believe it's between 150 and 250K that you can be on this scheme. After that, you have to leave it, and then all the 20% then is back to normal, where any sales invoices above any sales invoice tax you pay, and you net it off your purchase VAT, input VAT. Okay.
So you essentially mean that it's not 150K. So it's not like the day I move on 150K plus that I need to leave the flat rate scheme and move on somewhere else. It actually goes up to maybe 250K or 200K, whatever, but a slightly higher amount, right?
Yeah, exactly. So you can only join up with, yeah. So if you start you VAT register when you're 85K, right? But then let's say you don't have to automatically go onto the scheme straight away. But as long as your revenue is below 150K, then you can.
Right.
And then I believe if your revenue hits more than 250, then I think you've got to opt out of it. That's my understanding.
It doesn't stop at 150. You need
no.
But then what's the point of the 150K? Then I'm just anyway. I mean, but I get the idea then.
Yeah, exactly. Right. I think the rules are the rules, where it's just as long as it's below, well, yeah, if 150. Okay, thank you for the question.
Thank you.
No problem. So I think is there anything else overall on the question wise? Anything else that you want to ask? We've got a few minutes spare. On the various topics we discussed, or any other topics in general, which overall any of the other members of the session may find helpful.
Yep. Yeah. Hi, Yogesh. I have a very small question. Like after registering your company in UK, how quickly or how long it take to get an SEIS? You can straight away apply if you're having onboarded angel with you. You can straight away go ahead with that.
Okay, so very good question. So you've got your company, UK company registered, and then you're about to get angel funding. So an angel funder would ideally want to have the advance assurance paperwork that you receive from HMRC before they make the investment. Strictly speaking, you don't need the advance assurance, but no investor with the risk appetite to the need to get that income tax relief wouldn't want to jump in to your investment without that. So normally I tell clients budget say one or 2 weeks to prepare all this, or even a couple of days depending on how fast you are preparing a business plan, and then you complete the relevant form to HMRC. And historically it used to be anything between 4 and 8 weeks that HMRC came back with any queries or the confirmation that they approve your advance assurance. But my last one that we did, they came back within 5 days. So I was very impressed how fast things have turned around. And to answer your question further, what that doesn't mean is that the investor can straight away get the income tax relief. You will then need to trade for some months before you complete the EIS 1 compliance statement. And the wording is quite clear, compliance. So as long as you're compliant with all the EIS rules, they will then issue an EIS 3 form, which the investor then can use and put into their tax return. So there's a few sort of stages, but to answer your question, You just need to worry about getting advance assurance within 4 to 8 weeks as a minimum. And then once you've got that, any investor should be comfortable putting money into your business. And then a few months later, when the tax return year end is finished, you've completed this, they will then be able to get a certificate which you've completed for them called the EIS 3 for them to then get the income tax relief. Does that help answer your question?
Yep, it helps a lot. Yeah, thanks.
Okay, no problem. Is there anything else?
Hi, Yogesh, it's Kevin. Yeah, just a quick one on SEIS 3. What like does the investor have to have their taxes sort of completed to apply for it? So if we were to raise by the end of March, for example, and I get the SEIS 3 say in, I guess, May or June, do they have to have completed their I think 40 or 60, I can't remember, for them to start completing the forms, or can they do it at any given time?
No, it's a very, very good question, Kevin. And again, I could spend a couple of sessions on this. But the key point here, that's quite an investor requirement question. So what happens is that there is an ability, once you receive this EIS 3 compliance document here, right, on that particular statement or form, the investor can check a box to say claim a prior year income tax relief and send that to HMRC, or re-amend their prior year tax return. Because you're right, let's say you make an investment in May this year, right? So if you do that in May this year, if you want to make a claim in that tax year, you'll have to wait till the April the following year and then make the submission. But as long as you as a company have got this paperwork, the investor can make the decision to, if he or she has got income tax if they've got tax they paid in the prior year, then they can make a claim to reclaim that EIS, SEIS tax relief in the prior year. And one thing I would like to flag, and I always say to clients, there's a good planning point, is that brothers and sisters, the rules for who can qualify as an EIS, SEIS investor is complicated. One of the key criteria is that no one EIS, SEIS investor can be higher than a 30% investor. So a co-founder who has 50%. So I think Ali, you said you had, or Asif, you had a co-founder. So 50%, both of you couldn't claim any of this, right? But SEIS, if you're a director, you potentially can get income tax relief. So I've helped quite clever ways of actually allowing a co-founder to claim income tax relief if they want to invest some of their hard-earned money. So let's say they've worked in the professional world for a few years, they've paid tax in the UK, they then want to set up a business, they've got a co-founder, they may want to put money in, but that requires a bit of planning. But what I'm trying to give you some context is, if you've got a brother, if your parents want to invest in your company to help you, they won't be able to claim EIS, SEIS income tax relief, but your brother or sister, funny enough, can qualify. So we've had situations where a company is set up by a founder, and then he's allowed his brother to invest 20%. So he now owns 80 and his brother owns 20. And sometimes it's your family and friends that trust you the most, or willing to invest in you the most. And the best thing you can do for them is help them, in order for them to invest, help them get some income tax relief on their tax return on their previous year, as I just mentioned to you, or in the current tax year. So just a bit of extra help there on a wider training session, wider context. Okay, I think that can be it, unless there's anything else.
Any final questions from anyone?
Yeah, just to follow up on that. Thanks, that was very helpful. Sure. So I guess in terms of timeline, so if we complete it in this tax year at the very end, so actually March, so I guess for the investors, they could sort of say, they're claiming for essentially this tax year, right? They're not really retroactively claiming for this tax. Yeah.
But it's quite tight. So 5th of April is the end of the 2021 tax year. So if you can get your advance assurance, and just so you're aware, this is the busiest period for SEIS, EIS investment, because everyone, all investors, and I always tell entrepreneurs, where if you are looking to raise money, like all these seeders and crowdcube, this is their busiest time, because a lot of people, even my personal tax clients, they're looking at tax planning. How can they reduce their tax liability in an effective way, in a purposeful way? So one is getting some capital back by investing in the company which they really believe in, and just before the year end is an idea. So, but to answer your question, let's say you miss that deadline and it becomes 6th of April, the investment is made, then that investor, once they've got the EIS 3 certificate, they can claim it in the year before.
Oh yeah, makes sense. So it's pretty flexible in that sense, right?
Oh yeah.
Okay. Perfect.
Okay.
Thanks a lot.
No worries. Good. Well, I'm glad there's been a great number of engagement questions. So thank you for everyone on that, and hope you find the session useful, and good luck.